IVM.
Recep Tayyip Erdoğan, the president of Turkey for 4 years now, the prime minister of Turkey for over a decade before that. Mr. Erdoğan has been a villain extraordinaire on the global stage, and for Turkish citizens in particular, for some time now. He has been condemned for his authoritarian crackdown of the Taksim Square protests in 2013, for his widespread media censorship since then, which includes the jailing and deportation of many journalists. He survived a coup by the Gulen movement in 2016 and conducted a wide-ranging purge in response to that. And now, he's at least partially responsible for the Indian rupee hitting 70 against the US dollar.
Welcome to the Pragati Podcast, a weekly talk show on public policy, economics, and international relations. We are your hosts, Hamsini Hariharan
and Pavan Srinath. Turkey is the fulcrum of the emerging market currency crisis that we have been seeing over the past several weeks. This is a story that spans Turkey, the United States, Brazil, and our friendly neighborhood ally Pakistan, and many more actors. Narayan Ramachandran tells us all about it on this episode of the Pragati Podcast.
We'll be back after this short break.
So this week on IVM, there's a lot to look forward to for our listeners. If you're not following us on social media, please do. We're IVM Podcast on Twitter, Facebook, and Instagram. We have an interview lined up with the young actor Ishan Khattar on Cyrus Says. This conversation is about his foray into acting and living up to high expectations. On Simplified is the 100th episode, which we recorded live at Dulali, featuring guests Amit Verma and Varun Dugirala. And for all of those looking to step into the food and hospitality business, the podcast that should definitely make your priority list is the Kolaba Cocktail. This week, there's an important conversation taking place between Gauri, Pankil, Abhishek, and myself about restaurant investments, who the ideal investor for a restaurant would be, and more. Also catch Paisa Vaisa, where Anupam talks to Prashant Thakur of Anurag Property Consultants about real estate basics like buying, renting, and selling property. On the Vishal Gondal Show, Vishal speaks to Yashraj Akashi, someone responsible for curating the TEDx conference in India. On the Pragati Podcast, Pavan and Hamsini are joined by strategic communications expert Soren Dayton to discuss how the ecosystem of Washington, D.C. has changed since Donald Trump became the president. On Puliabati, Pranay and Saurabh discuss Pakistan's tryst with the military jihadi complex. We're also looking to hire a producer, a social media intern, and a graphic designer. So write to us at jobs@indusvox.com if you want to come work with us. And with that, let's continue with your show.
Hi, Narayan. Welcome back to the Pragati Podcast. So there's a lot of panic about, the rupee hitting 70. Is it going to hit 80? And then we see this in other countries of the world as well. And it's what's being called the emerging market crisis, right? Where does it all begin?
So thank you. And I'm delighted to be back here, Hamsini and Pavan. So delighted to be back and speaking, unfortunately, about a crisis again.
Every crisis is an opportunity for us to get you on the show, Narayan.
I will soon be known only as Dr. Doom or Mr. Crisis or something like that. But anyway, here I am, and I'm happy to speak about the origins of this crisis. So the origins of this crisis is in a Turkish bath. And by that I mean that we got set off on this path because the Turkish currency has lost nearly half its value this year. And why Turkey has reached that particular position is because Turkey, which is a country with a very low savings rate, had taken on, particularly through its corporates, a significant external debt. And that external debt is in hard currency. And of late, there has been a lot of political back and forth between Turkey and the United States. As several of you know, the United States has been asking for the return of a pastor who has been deemed to be a terrorist in Turkey, and Turkey sort of in solidarity and in expressing its sovereignty has denied that. And as a result of which there is this political cloud. And in the context of this political cloud, President Erdoğan of Turkey has basically said interest rates are not a way by which we can bring confidence back to the Turkish lira in this case.
So the madness has hit economics 101 now. I don't want to put words in your mouth, Narayan, but yes, I mean, we are seeing a lot of political turmoil domestically. I mean, this is a continuation of a lot of social and other policies that have also happened. I mean, to me, it sort of feels that way. Right?
Yeah, before we come to India and other populist governments, which seem to be the norm pretty much everywhere in the world, sticking for a moment with Turkey, if I may. So this cocktail of high external borrowing in hard currency combined with a low savings rate in an environment where investors are beginning to lose confidence in Turkey as a republic that is, one, a NATO republic, and two, at least until a few years ago, an aspiring member of the European Union. Now, all of that has come under a threat, certainly under a cloud, possibly even under threat. And so confidence sort of suddenly went away, and that resulted in the Turkish lira declining 50% year to date, but in particular 20% in the last month or so. And that set in place a chain reaction.
A chain reaction amongst countries around the world?
Yes. So this is the emerging market crisis that you were referring to Hamsini. What is not widely reported in India is that the INR, the rupee going down to 70, is part of this package of currencies declining against the dollar, so to speak. And for instance, the Chinese yuan has declined roughly 10%, as has the rupee. Brazilian currency, the real, has declined 18%. The Argentinian currency has declined so much it's difficult to actually calculate because now the denominator, one is not sure what to use as a denominator anymore. So it's roughly 60-70% of decline. And for those of you who follow Latin America, you might know that Argentina was just actually making its way back from having been through a pretty nasty macroeconomic period under the Kirchners, who were the two previous presidents of Argentina. So they were on the way back. They had negotiated way out of their old debt with the hedge funds and so on. And even as they were limping back, they now have to raise interest rates. I think interest rates in Argentina, again, it's tough to keep count because they change every day. But to the best of my knowledge, are like 35% now at the short end.
Okay.
So they have been raising rates in order to protect their currency. But despite that, the currency has lost a lot of money. So currencies across the world, as a sort of reaction to this little panic triggered by the lira, have all declined quite substantially. I'll point to the U.S. link in just a second, but you were going to say something.
Could you expand on how this sort of domino effect happens? So something goes wrong in Turkey. People lose confidence in the Turkish currency. How does that ripple over to other currencies? Is that because there are people who are speculating? Can you tell us a little about that?
Yeah, for that, again, I have to take a slight detour, and the detour now will take me back to the U.S. And that is this, that in the U.S., as probably, again, everyone knows, U.S. growth in 2017 and then now 2018 has been quite good.
Yeah, 4-something%.
Almost 4%, yeah. So very, very good relative to their trend growth rate and certainly relative to recent expectations of how well it was going to be. As a result of which, the long-term low interest rate sort of scenario that we had in much of the West, but particularly led by the Federal Reserve in the U.S., has to be normalized. There's a negative side from where the U.S. is coming. I'll come back to that. But if you would just keep it to simple, straightforward economics for a second, U.S. interest rates have started going up.
Okay.
And that process of the U.S. interest rates going up is one of normalization of U.S. interest rates, corresponding with normal growth and returning normal growth in the United States, and a decline in the size of the Federal Reserve balance sheet, which had obviously become very, very large when the U.S. had eased after the global financial crisis in 2008. So on the one side, you have dollar interest rates going up, and on the other side, you have confidence in emerging markets vulnerable, let's say. And that was the situation in the middle of this year.
Okay.
Now, on margin, when that confidence sort of pushes on edge, then what happens is global flows retreat to the dollar as a safe haven currency.
Okay.
So that's the flow that causes all of the currencies to depreciate at the same time, which is global pensions, global money flows retreat to, in this case, the reserve currency, the dollar. And in so doing, the dollar interest rate remains at its level and becomes the favorite destination. And emerging market currencies, which used to be high yielding, but now because of currency combination in dollar terms is less attractive than it was the day before, it flows out of emerging markets currencies back into the dollar.
So a lot of people, businesses, countries start selling emerging market currencies and buying more dollars.
Yeah. In fact, if you search hard enough on YouTube, you'll find a very interesting clip. It's in Turkish, of course, but you can read the text where Erdoğan is appealing to his citizens to say, please come out, sell your dollars and buy lira. So he's suggesting the opposite. But that's because global investors are exactly doing what you said, which is selling the local currency and buying it back in dollar. Because the dollar, not so long ago, I mean, you will remember that the dollar interest rate was 0.25.
Right.
Today, in some instruments in the dollar, you can get up to 4%.
Wow.
So
why would people want to leave?
Leave, particularly if the currency is going to be weak, and therefore in dollar adjusted terms, your high yielding currency is actually yielding lower than a 4% in dollar. That's the exact trade. So that's the first stage of an emerging market contagion, if you will. It's purely through money flows. The more serious contagion really comes from who owns the foreign debt, and are those institutions in trouble?
Okay.
So I'll give you an example from many, many years ago. So many years ago, the Latin American crisis of the early 80s was triggered by, again, a similar lack of confidence in Latin America, hyperinflation, high current account deficit, significant external borrowing, and then suddenly something snaps, and then, but there the banks that held the debt were all U.S. banks. Citibank being a famous example of a bank that held a lot of Latin American debt. In this case, in Turkey's case in particular, many of the banks are primarily European, Greek and Italian banks in particular, that own a lot of the Turkish debt. So a second stage contagion would come if those banks, because of this exposure, are in need of equity capital to recapitalize themselves in the context of a significant decline in the currency in which they lent.
So if I understand that right, so basically the banks which have loaned out money to Turkey no longer are as confident of getting that money back, or are they no longer as confident of Turkey repaying those loans, and so therefore they have to do other things to manage that.
And the reason why they're no longer confident is, just take a simple example. Let's say a bank in Italy loaned $100 to Turkey. At one point, you needed 350 Turkish lira to pay back the $100.
Right.
Today, you need roughly 700 lira.
Okay.
So the very same institution needs double the amount of money to pay back exactly the same debt.
Right.
And if your domestic cash flow doesn't sustain what is now a twice payment, that's where the lack of confidence comes from. And therefore, they will need to mark their books to market. And maybe they say, I don't get 350 back. Maybe it's not 700. Maybe I get 500 back. But then that difference between 500 and 700 has to be marked as a non-performing loan.
Right.
And the more you have that marked, that delta of 200 will pile up as a non-performing asset, and that will have to be capitalized on the bank's balance sheet. Now, if those banks are in turn heavily linked into other entities, that's how second-order contagion, which is often more serious, happens.
So, along with all this happening, so if the Turkish lira has now lost half its value, then what happens to the country's imports and exports? Right? Suddenly, exports become less lucrative. Imports become twice as expensive. So, what's the
Export become actually
competitive
attractive to the outside.
Right. You can buy it for cheaper.
Yeah, you can buy it for cheaper. And so sometimes you do. So if this hadn't happened in quite the same way, sometimes you do what is called a competitive devaluation.
Okay.
So that you use your export sector to regain competitiveness.
Okay.
Right. So if you have a managed currency crisis, and I'm going to put managed currency crisis within quotation marks, that is competitive devaluation. And actually, there is widespread agreement that China, for instance, did that in the mid-90s.
Okay.
And as a result, other countries had to competitively devalue their own currency to match where China had gone. But that's a managed issue. This is when it becomes unmanaged, then it goes into a crisis. But it is still true that exports from Turkey will now be attractive. So it's a very good time to buy a Turkish carpet.
Okay.
Right? But on the other side, imports become very, very difficult. And most likely, even though politically and economically Erdogan has suggested that he will not raise interest rates, eventually he will have no choice.
Mm-hmm.
And when he raises rates sufficient to hold this crisis, then what will happen is that Turkey will go into a negative growth rate, effectively recession.
Right.
And if Turkey goes into recession, then you have a very different scenario of the economy contracting. And if the economy contracts, then people are much less better off than they would be otherwise.
Right.
So
and then there'll be
maybe exports help a little bit, but at an overall level, the economy will not do well at all.
Okay.
And that's typically, very easy place to demonstrate how that happened was in the 1997 currency crisis in Asia. And, famously, Korea, for instance, had an IMF-backed plan to restore its currency back to normal. And within that context, people were famously removing gold from their teeth and putting it into the national treasury.
Wow.
In order to back the loans that they were taking from the IMF at that time. So typically it sends the country into a straitjacket of very tight reform and consolidated spending, and all of that results in a recession, which obviously politically is difficult to handle, but economically is the only way to sort of extract oneself out of this crisis. Now, Turkey, just to be clear, has not yet agreed to raise interest rates.
Okay.
And it still believes that it can fund its way out of the problem. As some of you may know, Qatar has offered $15 billion to Turkey, but that's not even a drop in the ocean. It's a droplet in the ocean, if one can use a mix of metaphors. And Turkey will need a lot of money. Turkey is a large country with a reasonable sized economy. It's not going to reset itself with just a little bit of money.
Okay, so is heavy external debt the only thing that's leading to the currency crisis, apart from the two levels of contagion that you'd mentioned?
Yeah. So usually these kind of crises are triggered by heavy external debt, and then a lack of confidence that's triggered by some factor. In this case, it was politics that triggered that lack of confidence. But currency crisis can also happen if the current account deficit is very high, and again triggered somehow confidence in the maintenance of the capital account to fund that current account deficit goes away. Okay. So, for instance, the most vulnerable currencies out of this Turkish current crisis have, for instance, been the Pakistan rupee. And Pakistan, as some of you may know, has a current account deficit of 5.7% of GDP. And so, once again, I think the 12th time in 2 or 3 decades, Pakistan's going back to the IMF. But this time is truly different because Pakistan, while in all past cases went readily back to the IMF, and the IMF, not readily, but certainly with some conditions, supplied the capital to get Pakistan's economy more stable. This time, even in Pakistan with a new government, there's a lot of political discussion about whether Pakistan should go back to the IMF at all. And I've actually read statements appearing in, Washington Post and New York Times, which says that senators in the US are using phrases like, why should we bail out Pakistan so that they can return the loan to China?
And there's also there's also that issue of Pakistan being on the FATF terror list already, right? For not cutting down on sources of terrorist funding. So the chances of them getting a bailout from IMF this time might be less unlikely than in previous instances.
More unlikely.
More unlikely.
Less likely, yes.
Yeah.
And this is also coming on the wake of American aid to the Pakistan treasury also declining, right? So it's in that sort of context that...
I don't want to get into the broader Pakistan-US relationship here. All I'm suggesting is that political language between countries which might have been considered out of the norm in the last currency crisis are very much the norm today.
Okay.
And so one doesn't know what to make of this thing. I mean, Pakistan going to the IMF, even in an environment in which US-Pakistan relations in respect of their other aid would have been okay in a era that is bygone, 5 years ago, for instance. But today, the whole thing is complicated. And one doesn't know, whether Pakistan will officially go back to the IMF at all. They've sort of made noises. It's a new government.
Right.
So they don't even have their ministers in place. I think the ministers are literally in place today. And so then whoever is the Minister of Finance has to actually, this will be the first job, will be to go back to the IMF. Second question is whether the army, which at least by reports is the one that is backing this government, will support it or not. Not entirely clear. And then second, on the American side, it's not entirely clear whether they'll view this differently from before. So for the first time, you have political language that is acceptably okay to say that it would have been politically incorrect before. But today they are actually saying, why should my money fund China is sort of what the senator in the US is saying. And that would not have been acceptable 5-7 years ago to say it quite that way. They might have said it behind the scenes in private meetings and might have extracted a condition or two for saying it. But saying it publicly in the press puts everybody on edge and in a very difficult kind of situation.
Right. And then if that doesn't happen and Pakistan goes closer into China's embrace, that raises its own set of problems for both Pakistan and for China, right?
Oh, and for the US.
And for the US and for India.
Yeah.
So we're in for an interesting time.
Yeah, interesting.
Okay, Narayan, I have a more fundamental question for those of our listeners who might have not caught the last episode that we did with you. What does it mean to have such a high current account deficit, as you said, in the case of Pakistan of, say, 5.7%? What does it fundamentally mean?
Yeah. We'll do a more detailed session on current account deficit, perhaps in a later podcast, because it can get somewhat technical and hairy, and I should warn listeners to have their cup of coffee ready before I actually start off on it. But at the simple level, what a current account deficit is when your imports are greater than your exports. This is at the simple level, right? There are elements to it, there are details to it that we can come to in the next session. But at the simple level, if I borrow from another country more than in goods and services, more than I sell to the other country, then I have a current account deficit.
Okay.
Now, in order to fund that, I have to have what is called a capital account surplus, which means that other country will need to pay me more than I send to them as well.
Okay.
Right? In a way, it's like a relationship with your rich uncle. Your rich uncle, you agree to polish his shoes and he agrees to pay you for it. If either side doesn't work, then it gets broken down a little bit. Okay. Right? So when that magnitude becomes high, and I can stretch the shoe metaphor quite a bit. Suppose I say you now owe him 50 polishes. Now it's a little less sustainable than 3.
Right.
Right? I mean, 3, you can get through it. Maybe by the end of the week, you'll actually polish his shoe 3 times. But 50 times, for you to be in the same place and for his shoes to be available to you and for you to have the polish at the right time, gets a little complicated. So I think that's the context in which this is. So when you have, and any growth economy typically has a current account deficit of, pick a number, 1 to 3%. And it's considered relatively normal, particularly for oil-dependent countries where oil forms part of your import basket. For instance, India has for very long run a current account deficit. And in India, we don't think of current account deficit as a problem if it is sort of 1 to 2.5%, typically. But when 2.5 becomes 4 and when 4 becomes 5, that's when, and that's the context of 3 polishes going to 50, that's when it becomes dangerous. And that's when, for instance, for reasons of their own, if US dollar interest rates go up substantially, then money retreats back to the dollar, and then the capital surplus that funds the current account becomes in jeopardy. So that's how a current account plays into the currency. And the only way to balance that is then with the currency depreciating.
Okay, so you brought me to my next question, which was Turkey and Pakistan both share, a high external debt and a current account crisis and some sort of political quagmire that we will not get into. Isn't India also vulnerable to these things? Doesn't India also borrow heavily? How is our current account deficit? And politics is something that I don't think we should get into at all. But aren't we just as vulnerable as these 2 countries to our currency depreciating?
The quick answer is no.
Okay.
Which is probably the good news in this entire discussion, that India is not as vulnerable, both as these countries are today, as well as India has historically been in the past. And it's not vulnerable for a few reasons. One, you have a professional set of institutions, in particular in the RBI in this particular case, which has correctly and prudently raised interest rates twice. Despite, some people saying you shouldn't be raising interest rates now, growth is still low, investment hasn't come back in India, and you shouldn't be raising rates. But sort of anticipating both the implications of oil price staying high, and it has stayed high now for a few months, and this crisis that transpired over the last 2-3 months, the Reserve Bank has actually prudently raised rates. So that's the first thing they've done. The second thing is we also have a reasonable amount of reserves. And that you can say order of magnitude, we have $400 billion of reserves. And that allows you to use to sell dollar and buy rupee, is the way that you would say it as a central banker, so that you can stabilize the rupee from dramatic decline. So I would actually separate, even though all currencies, many currencies declined in this particular episode. As I mentioned, the real, the currency in Argentina,
the yuan,
the ruble, and many more. But I would distinguish, for instance, the Chinese yuan, the Indian rupee, the Indonesian rupiah from that group by saying that the institutions in these countries are taking by and large the right approach, number one. Number two, they have enough reserves to bring stability. And number three, so long as they continue to follow a set of prudent actions, then these currencies will decouple from this crisis. The crisis is real for Turkey. And the crisis may well be real for Pakistan, partly based on what actions they take. But for India, China, and rupee, this is a collateral damage. And the collateral damage will stop and hopefully will reverse, at least modestly, if not fully, sometime in the near future. So I think this sort of mindless extrapolation of the rupee to 80 and 90 is unwarranted and certainly not supported by a reading of the situation as well as a reading of the response that's taking place in India and the yuan. So the yuan, as you know, famously, I think, if I'm not wrong, actually touched 7 and
against the dollar.
Against the dollar, and it was at 6.4 earlier this year. So it moved,
Very similar to us.
very similar to the rupee. So except there's a decimal, but
So in that sense, rupee has not done poorly against the yuan.
no, maybe very modestly, maybe more about 1%.
But that's
worse,
not.
But not much worse.
So in that sense, it also doesn't affect our trade with China too much.
Correct. The bilateral terms of trade with with China have not changed at all, which is
excellent
kind of
for
strange.
India.
Yeah. So it hasn't changed very much at all. Of course, the terms of trade with China are a discussion we can have in our current account deficit. India has different problems with China, which is India exports low value goods and imports higher value goods.
Right.
And this is the same problem, but by the way, that China has with the US.
Okay.
So part of the reason why all of this trade war is going on from the US's side is that China and Germany have an extraordinarily trade surplus with the US. And the terms of trade for the US are actually poor with both those countries.
Okay.
So from a purely domestic politics point of view, President Trump is arguing for balance in that trade equation.
All right.
But strangely, and this statistic probably very few people in India know, China for the first time in 17 years has shown a quarterly current account deficit.
Okay.
Not happened for a long time. I mean, we have all lived through a generation in which China only showed current account surpluses. And still at an annual level, it is still likely to show a surplus, even though the magnitude of the surplus is going to go down. But the very fact that I can sit here and use China and current account deficit in the same sentence is itself a 2018 phenomenon. It's not happened earlier.
And this
for
is
a long time.
because of Trump's trade war moves and threats or something else?
It is many factors. We'll have to discuss
Sure.
China in factor, but it is definitely part of this is because of the trade war, and part of it is therefore because of lower exports to the US from China's point of view, and because there's some slight lack of believe it or not. I mean, actually, again, the sentence that I don't think I would have used, a little lack of confidence in the Chinese economy coming from the trade war.
Okay.
Oh, wow.
Right. So it's all happening for the first time in the middle of 2018, and not terms that you would have even used 2-3 years ago as a possibility. But it's happening. And the if and I say the probability of this is very, very low. And though I have actually seen 1 or 2 analyst reports that actually point to it, but I would still say the probability is very low. If China prints a current account deficit for an entire year, then we are in unprecedented new territory. Then then the entire, Trump will declare victory, but his entire strength of his game will change because it was based on the current account between China. Of course, China still has a surplus with the US, but overall, if it has a current account deficit, then the argument that China is dumping into the world, it becomes much less strong than before.
Okay.
But low probability as of now, but Chinese current account surplus will go down in magnitude. It used to have a current account surplus of order of magnitude 4% of GDP.
Wow.
It's probably going to go down to 1.5 this year.
Okay.
And very, very few people are saying it may actually be 0.
Okay.
But as I said, I don't believe it. But,
Who knows?
theoretically, it's a possibility.
Okay. Coming back to India, Narayan, I mean, you said by and large, the Reserve Bank has reacted to this properly. I mean, there's been a good sort of technocratic response. But we are also in the second half of 2018. We have 3 state elections coming up. Big ones, and we have the national elections coming up next summer. So this is a time when, while India doesn't have a extremely high fiscal deficit anymore, we're slowly bringing it down. We still have a fiscal deficit, and things can go wrong, right? So what what should we be expecting over the next year? I mean, should the RBI be very strong in staying its course? Will the pressures on it increase?
Yeah, so I mean, this is another discussion that merits a long one, which is about the strength of institutions and how they need to play a very strong role. As if emerging markets didn't have enough problems anyway, they need to have one additional criterion, and that is at all times, the spine of the emerging market needs to be connected to the brain of the emerging markets. First, you have to have a brain, and then you have to have a spine, and the brain and the spine have to be connected. And that's a tall order, right? So you take Reserve Bank in this case, has demonstrated first the right brain, and then second the right spine so far. But in an election season, that connection between the brain and spine needs to remain.
Right.
And sometimes the spine gives way and so goes the brain with it, So I'm just hoping that with 3 state elections in Chhattisgarh, Rajasthan and Madhya Pradesh, and then subsequently the union election coming up in the early part of next year, sometime before May, that the Reserve Bank is able to hold its response or hold its right to the right response.
Okay.
In this context of a political season that's upon us, and if they do, then I think there's the currency related risk is modest. Of course, the macroeconomic risk remains, and the macroeconomic risk remains, which is that India's fiscal situation shouldn't slip too much, because that, particularly in the context of a stubbornly high oil price, can be inflationary. And second, that the investment side of India has remained anemic now for 8 or 9 years. So in the classic C plus I plus G equation, I has not fired at all.
The investment one.
Yeah. And it didn't fire when inflation was relatively low last year. So when inflation is picking back up, partly through currency and partly through oil, what little green shoots there were may be squished under the inflation shoe, so to speak. So in that sense, the macroeconomy of India is not out of the woods from a steady growth point of view. And we can only hope that the currency episode passes, and with it the inflationary quotient reduces, so that 1, the need to raise rates goes down, and 2, hopefully we can even bring rates down. Okay. But that's a while away. I think the next 2 moves, if anything, are likely to be up rather than down.
Okay.
On the interest rate, which obviously has an implication on growth. And it has an implication on growth in an election season. So this is makes for masala chai, if nothing else.
All right. So, Narayan, before we let you go, one final broad question. We've largely discussed the macroeconomics of these currency crises, and we've sort of alluded to something going on between Turkey and the US, a little bit going on maybe with Pakistan and its relationship with the US. But is there a larger geopolitical game that's also happening in the background?
Yeah, I'm glad you asked that question, because I think some of the political rhetoric between the US and Turkey, and then even broadly, is coming from a new great game that is being played in the Middle East. And I think it all began with the US sort of withdrawing a little bit from the Middle East, while at the same time putting the squeeze again now on Iran. And so there is a fight for what the geopoliticians would call hegemony in the Middle East, and that fight is taking place between Iran, Turkey, Qatar, and Saudi and UAE together. And you saw manifestations of that crisis when Saudi sort of blacklisted Qatar, a year and a half ago. You're seeing it in the way Saudi Arabia is playing a very activist role in the civil war in Yemen, and you are seeing it in a covert but underlying war within Iraq.
Right.
So there is it's not a full-fledged civil war, but there's a jockeying for Shia Sunni power within Iraq. So this is now the new great game in the Middle East, and Turkey entered that game. And so part of what we are seeing here is a little indigestion coming to Turkey from Turkey's participation in that great game. And I think that's the topic for another day, which we should have with our colleague Nitin also in the room. But I think the likelihood that we will see a very different power equation in the Middle East 5 years from now than we have certainly 5 years ago, possibly even what we have today, seems very not only plausible but very likely. And you know, with so many nationalists in power around the world, the undercurrent is, I used to have a great empire. I need to reclaim it. And the Turkish version of that is the Ottomans. Right? Every one of these countries has one version of it.
There's an Akhand Bharat, there is the Ottoman Empire.
Yeah, there's you know, there's the Russia in the early Tsar days. There's the Middle Kingdom in China.
So basically, this is the return to the golden ages and the vying of that's leading to this geopolitical churn in the Middle East.
Correct. And the presence of nationalist authoritarians in power in many, many countries. So the combination of the two return to a past gilded age at the same time. And the reason that you want that is because you have these nationalist authoritarians sort of representing their countries, that view. And each of them is trying to say, you know, this is how we used to be great. And of course, the Ottoman Empire was substantially all of the Middle East. And so it makes sense that Turkey would want to aspire to hegemony in the Middle East. Of course, Saudi Arabia is not going down that same nationalist path, because Saudi Arabia was not really a country for a very long time. But Saudi Arabia is now coming as a new power, saying, you know, I have the money and I have a standing and I should stake my claim to this region as well. And so that's where Saudi Arabia is coming from. And is represented by a new, young heir to the throne, so to speak. Right. So
yeah, there was that churn in the House of Saud, right? But, you know, so from all of this, you're saying there's good news from India, for India, in the emerging market crisis. But it's not all good news, because we're still in for a lot of churns in the global markets. Is that how we would sum it up?
No, I would slightly characterize it differently. First, the news for India is less bad than many other countries. So that's the first thing I would say. Second, it's not entirely clear what will happen to the global environment. The Turkish crisis is not over. It's not over because, one, Turkey has not raised rates. Two, Turkey has not got the money to back its currency. And so hedge funds will take another run at the currency if nothing happens. So if you get 2-3 weeks of a status quo and nothing's really happened, then somebody will try to upset the apple cart by shorting the lira. So it ain't over. But the contagion, which is, you know, 70 today, 80 tomorrow, being inevitable, I think that can be sort of ruled out. We may have to raise rates again if lira goes down further. But now you could have the other lower probability, but you could have the other case as well, which Turkey finally sees the wisdom in defending its currency in a much more orthodox way. And I mean, economically orthodox, not politically orthodox. That might have been part of the problem. But if it defends its currency in a politically orthodox way, then you may begin a much more stable period for a little while anyway. But even if you don't, I think the Indian currency and the Chinese currency in particular, but perhaps even the Indian currency will be less affected. Separate from that, we were speaking about the Indian macroeconomy. That is not in the pink. It is, you know, it's not pitch black, but it's oscillating between partly sunny and partly cloudy.
And going towards an election, more clouds will gather on the horizon.
Could gather, and if that is in particular, if institutions don't have the spine to stick the course, and that is everything. That's the Election Commission as an institution. That's the Reserve Bank as an institution, and or other institutions don't engage in the arbitrary use of power, as again in an election season, right? So you don't misuse the CBI or other entities for political purposes. So if politics stays away from institutions, or institutions have the ability to resist politics in the next 6 to 9 months, then this too shall pass for India. But if the institutions succumb, then it's not good news. And I'm not too worried at the moment about that. I don't want to give a completely sanguine picture on India, but it's less bad.
Less bad. So thank you, Narayan. On that note, it was a pleasure to have you again on the show, and we hope to have you back here before too long.
Yeah, please do invite me when there's no crisis.
We will.
Thank you for staying with us till the end.
Visit our website at thinkpragati.com for your daily dose of brain fodder on all things public policy.
You can subscribe to the Pragati Podcast on the IVM Podcast app or wherever else you get your podcasts from. We're there everywhere.
Shunyawan, 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 Shunyawan.
$1 billion acquisition. Another copycat startup got formed.
No, the tech world in India is surely moving double the speed of this voiceover.
Tune in to Shunya One every Tuesday to catch us talking to the smartest people we know on the IVM Podcast website, app, or wherever you get your podcasts from.
Yeah. It's IVM here. Let's go. We the IVM kids on the block over here. Just to talk, taking a break from producing all day. Coming on this podcast because we got stuff to say. IVM Daily is the name of the show. Monday to Friday, we ready to go. Talking about stuff in our head. We might even talk about our favorite bread. Signing out, it's IVM here, the podcast network that's in your ear.
Catch IVM Daily, Monday to Friday on the IVM Podcast app or wherever you get your podcasts.